Welcome to the deep dive. Ever wondered what auditors really do beyond just checking the numbers? Today, we're pulling back the curtain on some of the hidden complexities, the tricky situations they face, all to make sure you get the most reliable picture of a company's financial health.
Indeed. Our mission today is really to shine a light on specific areas of risk that auditors have to navigate. We want to sort of demystify how they gather that crucial evidence, helping you understand not just what an auditor does, but the profound why behind their work. It's pretty important stuff.
Yeah, absolutely. When we think about financial statements, it's easy to picture, neat spreadsheets, clean columns of figures. But underneath all that, there's this complex world governed by rules, laws, regulations. And that brings us right to our first major challenge for auditors, making sure a company actually plays by the rules.
Precisely. Financial statements don't exist in a vacuum. They operate within this vast legal framework. And when we talk about non-compliance here, we're not necessarily talking about like one rogue employee doing something wrong. It's any act could be accidental, could be intentional, an omission, a commission by the company itself that goes against the relevant laws and regulations.
Okay, so if a company, let's say, forgets to file a crucial environmental report, even if it was an honest mistake, that counts. Or if they deliberately mislabel something to, I don't know, dodge taxes, how does that kind of rule bending actually show up on the financial side?
Right. Well, some laws have a very direct impact. Think tax laws, for example. They immediately affect the amounts reported, the numbers you see right there in the financial statements. But many laws have more of an indirect effect. Violating those might not, hit the balance sheet right away, but they can lead to major consequences down the line. Huge fines, penalties, maybe even a lawsuit. And those consequences absolutely impact the financials eventually.
That makes perfect sense. I mean, a massive lawsuit could definitely crater a company's financial health. So who's ultimately responsible for keeping a company on the straight and narrow with all these rules?
The primary responsibility rests with management, and those charged with governance think the board of directors. They're the ones who have to ensure the entire entity operates in full compliance with all the applicable laws.
And the auditor, then? Are they supposed to be like legal super sleuths, expected to unearth every single violation, big or small?
Not quite, no. The auditor's role is to obtain reasonable assurance. That's the key phrase. Reasonable assurance that the financial statements are free of material misstatement due to non-compliance.
Okay, reasonable assurance and material misstatement. Break those down a bit.
Sure. Reasonable assurance means a very high level of confidence, but it's not absolute. Think of it like a thorough health checkup. We can tell you a lot, find most significant issues, but we can't guarantee you'll never get sick. And material misstatement means something significant enough that it could actually influence a decision someone makes based on those financial statements. Crucially, auditors aren't there to prevent non-compliance, and they realistically can't be expected to detect every single instance, especially if it's kind of far removed from the core financial transactions.
That sounds incredibly difficult. What makes it so challenging? What are the built-in limitations for an auditor trying to spot this stuff?
There are definitely several hurdles. First, like we said, many laws don't directly affect the financial statements or aren't even captured by the accounting systems. They're operational, maybe HR related.
Right.
Second, non-compliance can be actively hidden. People might collude, forge documents, deliberately not record transactions, or management might just override controls and, frankly, lie to the auditor. And finally, remember, whether an act truly breaks a specific law is ultimately a legal determination, not an accounting one. Auditors are financial experts, not necessarily legal experts.
Okay, so given all those hurdles, how do auditors even begin to tackle this? What are their practical steps? What do they actually do?
Well, when an auditor starts an engagement, they first need to get a really good understanding of the whole legal and regulatory landscape for that company and its industry. They also try to figure out how the company's already trying to comply. What systems do they have in place? Then, for laws that do directly impact the numbers, like tax laws, they gather specific evidence related to those amounts and disclosures.
And for those indirect laws, the ones that could cause big trouble later but don't immediately show up on the balance sheet, how do they sniff those out?
For those, auditors have specific procedures. They'll inquire with management, ask the board about the company's compliance processes. They also inspect correspondence with regulatory bodies, letters back and forth with the EPA or the FDA or tax authorities.
Yeah.
That can be very revealing. And beyond these targeted steps, auditors are always keeping their eyes open for clues of noncompliance across all their audit work. It's about taking this holistic view, kind of piecing together a puzzle from every available piece.
This really sounds like walking a tightrope. What happens when an auditor actually suspects something? That can't be an easy conversation to initiate with a client.
No, it's definitely not. If noncompliance is identified or even just suspected, the auditor has to discuss it with management. Ideally, they talk to someone at least one level above whoever might be involved. They'll also likely bring it up with those charged with governance, the board. If management can't provide clear proof they are compliant and the potential impact seems significant, the auditor might need to advise the company to consult their own lawyers, or the auditors might even seek their own legal advice.
And this suspicion changes things.
Oh, absolutely. It forces the auditor to reevaluate the company's overall risk profile, maybe question how reliable management's other statements are. Ultimately, it could affect the audit opinion itself. And in very rare, very severe cases, if it's allowed by law or regulation, the auditor might even have to withdraw from the engagement entirely.
Wow, withdrawing is a huge step. So let's say non-compliance is confirmed or at least strongly suspected. How is it actually reported? Do they just, spill the beans to everyone?
Not typically, no. Internal reporting is the main obligation. The auditor needs to communicate it to the board unless the issue is clearly trivial, clearly inconsequential. If it seems intentional and material significant, they communicate it as soon as practically possible. Now, if management or even the board themselves are involved, the auditor has to go to the next higher level of authority within the company. If there is no higher level, they might need to get legal advice on what to do next.
Okay, that's internal. What about telling outside parties? Does that ever happen? Is the auditor a whistleblower?
Generally, no. Because of the duty of auditor confidentiality, disclosing noncompliance to outsiders isn't usually their job. It's a cornerstone of the relationship. But there are very specific, limited exceptions, like if a new auditor formally asks for information from the previous auditor, or if there's a court order demanding disclosure, or sometimes if they're auditing entities that receive federal financial assistance from a government agency. But those are pretty rare scenarios.
Gotcha. And how does this noncompliance ultimately affect the final audit report, the one that investors and banks and everyone sees?
It directly impacts the auditor's opinion. That's their formal conclusion on the financial statements. If the noncompliance has a material effect on the financials and it hasn't been adequately reflected or corrected, the auditor will issue either a qualified or an adverse opinion.
Qualified or adverse?
Right. Think of qualified as saying, hey, these statements are mostly okay, but there's this one big specific problem we need to tell you about. Adverse is much stronger, basically saying these financial statements are fundamentally misleading because of this issue.
Mm-hmm.
Now, if the auditor couldn't get enough information to figure out the impact of the noncompliance, they'd issue either a qualified opinion or, even more seriously, a disclaimer of opinion.
A disclaimer
Meaning, we couldn't get the evidence we needed, so we can't even form an opinion on these financial statements. It's a major warning sign. And if the company actually refuses to accept that modified report, the qualified, adverse, or disclaimer, the auditor should just withdraw from the engagement and inform the board in writing why they're leaving.
Okay, let's try and make this concrete. You mentioned an example earlier, healthy healthcare and HIPAA. How does that play out in this context?
All right, so healthy healthcare, let's imagine, provides care for children. Like any U.S. healthcare provider, it has to strictly follow HIPAA rules, the Health Insurance Portability and Accountability Act. HIPAA has really rigorous rules about protecting patient privacy. Now, ensuring patient privacy doesn't directly affect, say, how you record sales or expenses, right? It's not a direct accounting number.
Right, seems separate.
But if there was an unauthorized disclosure of confidential patient data, a breach that could lead to massive fines, lawsuits, really severe consequences.
Okay, which, like we discussed earlier, could then result in a contingent liability that needs to be disclosed in the financial statements.
Exactly, spot on. Such a situation, even if it's just suspected, would absolutely require disclosure in the financial statement notes about that potential liability from the HIPAA violation. So even though HIPAA isn't about the numbers on the balance sheet itself, an auditor, let's call him James, would have to specifically ask management about their HIPAA compliance, look their internal controls around patient data, and inspect any correspondence they might have had with regulatory agencies about it. And here's where it gets really interesting for you, the listener. The effects of noncompliance aren't always obvious or direct. The auditor has to connect those seemingly unrelated dots back to the potential financial impact.
That's a perfect lead-in to our next area, accounting estimates. We just navigated the sort of firm rules of compliance. Now we're heading into something that sounds inherently less precise, more like judgment calls.
Indeed, that's a good way to put it. An accounting estimate is basically any monetary amount in the financial statements that has an inherent lack of precision. We sometimes call this estimation uncertainty.
Hmm.
Estimates are necessary because, well, sometimes it's just not practical or cost-effective to get perfectly precise data about past events in time for the financial statements. Or sometimes the actual measurement depends entirely on something that will happen in the future.
So it's not a complete wild guess, but it's definitely not an exact science either. And it's management who's responsible for coming up with these estimates, right?
That's absolutely correct. It's management's job to figure out where estimates are needed, make reasonable ones that's key, and then include them properly in the financial statements.
Can you give us some common examples? What kinds of things are we talking about here?
Sure, yeah. Very common ones include the allowance for expected credit losses on receivables, basically, estimating how much money a company expects not to collect from its customers. Also, things like employee retirement benefit obligations, warranty obligations on products sold, figuring out the probability of losing a pending lawsuit and the potential payout amount, and even estimating the fair value of various assets or liabilities, like the value of a brand name or specialized equipment or complex financial instruments.
With all that built-in imprecision, I can immediately see there's a risk of bias creeping in. Seems like a perfect place for management to maybe nudge the numbers a bit.
You've hit on a critical point there. Accounting estimates are inherently imprecise, and crucially, they can be heavily influenced by management judgment. Now, this judgment might involve unintentional mistakes, sure, but it can also involve intentional management bias. The more subjective an estimate is, the more it relies on opinion rather than hard facts. The greater its susceptibility to that bias, and the higher the risk that the resulting number will be materially misstated. The key insight here for everyone listening is that these best guesses are precisely where management has the most room to potentially swing the numbers, making them a real high-stakes area for auditors.
Okay, so how does an auditor approach this potential minefield of estimates and bias? What does their deep dive look like here? They can't just accept the number, right?
Absolutely not. Professional skepticism is paramount. Auditors have to maintain a very healthy dose of skepticism when looking at these estimates, precisely because of those inherent risks and the potential for management bias or even fraud. They need to understand, first, the company's transactions that actually create the need for the estimate. What are the underlying activities? Then, what do the accounting rules actually demand for this specific estimate? What's the required method or disclosure? They need to understand the nature of the estimates themselves. How uncertain are they really? And critically, what internal controls does management have in place around creating and monitoring these estimates?
Controls like?
Like, who oversees the process? Does the company use people with specialized skills if needed? How is IT involved? And importantly, how does management review past estimates to see how accurate they were? Do they learn from mistakes?
And what if an estimate is particularly complex? Say, valuing some super specialized asset, like a unique piece of art owned by the company, or a really cutting-edge financial derivative?
Yeah, good question. In those cases, the auditor needs to assess if they need their own team members with specialized skills or knowledge. It's like bringing in an expert appraiser or maybe a financial engineer to help understand and evaluate the risks, perform the right audit procedures, and reach found conclusions. You can't audit what you don't understand.
Makes sense. So once they have that understanding, how do they actually assess the risk that a particular accounting estimate might be materially wrong?
Auditors assess risk at two levels. Inherent risk. That's the risk before considering any controls, and control risk, how well the company's own systems mitigate that risk. They evaluate the degree of estimation uncertainty involved, how much guesswork is really needed. They look at how inherent factors like complexity or subjectivity impact the method management used to calculate the estimate, the key assumptions they made, and the data they plugged into their calculation. They also closely scrutinize management's final point estimate, that specific number management lands on for the financial statements, and any related disclosures explaining it. All of this helps them determine if that particular estimate poses a significant risk of being materially misstated.
And their response to that risk. If they flag an estimate as high risk, how do they gather solid enough evidence for something that is, by definition, an estimate?
Right, the audit procedures have to be directly responsive to that assessed level of risk. Basically, higher risk means you need stronger, more persuasive evidence. There are three main approaches auditors can take. First, they can look at subsequent events. What actually happened after the balance sheet date, but before the audit report is issued? Did events confirm or contradict the estimate? Second, they can directly test how management made the accounting estimate. This involves digging into their process. And third, especially if the risk is very high or management's process seems weak, the auditors can develop their own independent point estimate or range to compare against what management came up with.
Okay, let's break down that second approach. Testing how management made the accounting estimate. What exactly does that involve digging into?
It means getting into the nitty-gritty. Auditors look at the methods management used. These are the specific measurement techniques or models. For example, using the Black-Scholes formula to price stock options. Is that the right method here? Then they scrutinize the significant assumptions. These are the judgments management made based on available information, like predicting future interest rates or growth rates or market conditions. Are these assumptions reasonable, consistent? And finally, the data. What actual information did management feed into their calculations? Was it accurate, complete, relevant? This could be historical sales data, market prices, projected quantities, whatever is relevant. Auditors plan specific tests on these methods, assumptions, and data to ensure they're appropriate for the estimate and, critically, to identify any potential signs of management bias in how they were selected or applied.
How do you spot that bias? That seems like the hardest part. Are there particular red flags auditors look for when it comes to management bias in estimates?
There are definitely indicators, yes. For example, if management makes subjective changes to an estimate or the method they use, claiming there's been a change in circumstances, but those changes consistently seem to make the company's financial position look better. That's a potential flag.
Convenient changes.
Exactly. Or if the specific assumptions management picks when there might be a range of reasonable assumptions, always seem to lead to an estimate that aligns perfectly with management's financial objectives or targets. Also, a recurring pattern over several years of estimates being overly optimistic, or maybe overly pessimistic depending on the goal, can also be a warning sign of bias.
What about those really complex estimates that might even involve specialized computer models? You mentioned auditors might need specialists. How do they test those?
Right. For complex models, auditors consider several key things. First, has the company actually validated the model? Does the underlying theory make sense? Is the math accurate? Second, are there proper change control policies in place? This is crucial to make sure no one is just tweaking the model's code or inputs without authorization or documentation. And third, does management actually have the necessary skills and knowledge to truly understand and use that model effectively? It's not enough to just press a button and get a number. They need to understand how the number was generated and its limitations.
Okay. And when all else fails, or maybe if the risk is just too high, the auditor might develop their own estimate or range. How does that process work? Do they just redo management's work?
It's more about creating an independent benchmark. An auditor's own point estimate or range is a number, or a set of numbers, that they develop to evaluate the reasonableness of management's estimate. They have to make sure their own calculation or range only includes amounts that are supported by solid audit evidence and are genuinely reasonable in the circumstances. They might achieve this by using a different model, maybe a commercially available one, or they might use the client's model but plug in alternative, independently verified assumptions or data. They might even engage their own specialist, like an actuary or valuation expert, to develop and run a separate model.
So after all this testing, or maybe developing their own estimate, how does the auditor finally conclude? How do they decide if management's estimate is ultimately reasonable?
They perform an overall evaluation, bringing everything together, all the evidence they've gathered. They double-check that their initial risk assessment for that estimate still holds up. They confirm that management's approach, how they recognized, measured, presented, and disclosed the estimate, aligns with the applicable accounting rules. And critically, they determine if they've obtained enough strong, appropriate audit evidence to support their conclusion. They consider all the information, both the evidence that corroborates what management says and any evidence that contradicts it. If, at the end of the day, an estimate is found to be unreasonable, or it doesn't conform to the accounting standards, the difference between the recorded estimate and the auditor's best estimate of what it should be is treated as a misstatement. And that misstatement needs to be evaluated along with all others found during the audit.
Well, let's make this practical again. A really common estimate is the allowance for doubtful accounts. Many listeners might be familiar with that one. How would an auditor evaluate its reasonableness?
Ah, yes, the allowance for doubtful accounts, or sometimes called the allowance for credit losses. This is basically the company's best guess at how much of the money its customers owe them, accounts receivable, won't ever actually be collected. Accounting rules require this estimate so that the receivables shown on the balance sheet aren't overstated, they reflect the amount the company realistically expects to collect. So, an auditor would typically start by sitting down with the client to understand the method they use. Often, it's based on an aging of the receivables, grouping debts by how old they are, with the assumption that older debts are less likely to be collected.
Right, the longer someone owes you money.
Exactly. The less likely you are to get it. Then, the auditor would discuss the assumptions management made. What specific percentages are they applying to those different aging buckets? Are those percentages reasonable based on history and current conditions? Are there any other factors considered, like the overall economy or specific issues with the major customers? They'd also obtain the underlying data, like the detailed accounts receivable trial balance and the aging report itself, and test its accuracy. They'd recalculate the estimate based on the company's method. If management uses different percentages for certain types of older debts, the auditor would assess if those seem reasonable and ask specific questions about any very old, large unpaid balances.
Because those individual large old balances could really skew the whole estimate if they're not properly considered, right?
Precisely. They could represent significant potential losses. The auditor would also look at the company's track record, their historical write-offs of bad debt, and they'd compare the current year's allowance to the prior year's allowance, considering changes in sales and receivables, to see if the current balance seems adequate, too low, or maybe even too high. What's fascinating here, and really important for understanding the auditor's role, is how something like this allowance account, which sounds so technical, is actually a key area for assessing management judgment. Because this estimate directly impacts the company's reported net income, how profitable they look. Management's estimates in this specific area are particularly susceptible to potential bias. It's a prime example of why an auditor needs to dig deep, apply skepticism, and challenge the judgment behind the numbers.
That's a really clear picture of how estimates work. Okay, moving on to our next complex area, related party transactions. These just sound inherently tricky because of the relationships involved. What are we talking about here?
They certainly are inherently tricky. Related party transactions, often abbreviated as RPTs, are essentially deals or arrangements between parties where one party has the ability to influence the other, or where both parties are under common control. This includes things like a parent company doing business with its subsidiary, or transactions between two subsidiaries owned by the same parent. It also covers deals between the company and its principal owners, its top management, or even their immediate family members. The crucial point here is that these transactions are not automatically considered arm's-length transactions, meaning they weren't necessarily negotiated on the open market between two completely independent, unrelated parties looking out for their own best interests. The existing relationship itself could influence the terms of the deal, things like the price, the payment schedule, interest rates, you name it. Because of this potential influence, accounting rules generally require these transactions to be specifically identified and disclosed in the financial statements. The idea is that the substance of the transaction, the real economic impact, might be very different from its legal form because of that relationship.
So it's not just about the numbers recorded. It's about providing the hidden context, the nature of the relationship behind the deal. What's the auditor's main responsibility when they encounter these?
Auditors have a significant responsibility here. They must perform procedures designed to identify any related party relationships and transactions that management might not have already identified or disclosed. They need to ensure these transactions are properly accounted for according to the accounting standards, and very importantly, that they are transparently and adequately disclosed in the financial statement footnotes. Understanding these relationships and transactions is also highly relevant to the auditor's assessment of fraud risk. Why? Because it's often easier to conceal fraudulent activities or misappropriate assets through transactions with related parties, where influence or trust might already exist, bypassing normal controls.
That makes sense. So what are the auditor's main objectives when they're specifically looking at RPTs? What are they trying to achieve?
The auditor really aims to achieve a few key things. First, to recognize any fraud risk factors that might arise from these relationships and transactions. Second, to conclude, based on the evidence, whether the financial statements, insofar as they are affected by these RPTs, are still presented fairly and don't contain material misstatements. And third, to obtain sufficient appropriate audit evidence about whether those related party relationships and transactions have been correctly identified, properly accounted for, and fully disclosed in accordance with the accounting framework. The ultimate insight for you, the listener, is this. If we can't be sure that a transaction was truly done at arm's length, we can't fully trust the company's financial story related to that transaction without more information. It's about looking beyond just the price tag on the deal to understand the true intent and potential influence.
Okay, so how do they actually find these transactions, especially if management hasn't flagged them? What are the typical audit procedures?
Auditors use a combination of procedures. They start by gaining an understanding of the company's own process, including its internal controls, for identifying, authorizing, accounting for, and disclosing RPTs. How good is the company at finding these themselves? They'll often obtain written conflict of interest statements from key management and governance personnel. They specifically request from management, and sometimes others within the organization, the names of all known related parties, details about the nature of the relationships, and information on any transactions conducted with them during the period. They might test the balances of accounts that are likely to involve related parties, like certain receivables or payables. They inquire about the existence of any unauthorized or unapproved RPTs.
Do they talk to the board about this?
Yes, absolutely. They inquire with those charged with governance regarding their knowledge of significant RPTs and the company's controls over them. They also review regulatory filings, like SEC filings for public companies, which often require disclosure of related parties. They review significant or unusual transactions identified during the audit, especially those near year-end, looking for indicators of related parties in things like bank confirmations, legal confirmations, or board meeting minutes. They might even look back at prior year audit documentation, or if it's a first-year audit, inquire with the predecessor auditor about known related parties. It's a pretty comprehensive, almost investigative approach sometimes.
And what happens if management claims an RPT was an arm's-length deal? Maybe they sold something at market price, but the auditor just can't find enough evidence to confirm that assertion.
That's a tricky situation. If management makes a statement in the financial statements asserting that a specific related party transaction was conducted on terms equivalent to those prevailing in an arm's-length transaction, but the auditor cannot obtain sufficient appropriate audit evidence to substantiate that claim, the auditor should issue a qualified or even an adverse opinion.
So basically, if the client claims the deal was totally fair market, but the auditor can't verify it independently, they can't give a clean report on that aspect.
Exactly. It really underlines the importance of transparency and having verifiable evidence, especially when dealing with transactions where inherent conflicts of interest might exist. You can't just take management's word for it on something like that.
Are there specific indicators or red flags that auditors are trained to look for? Signs that might subtly point towards a hidden or improperly characterized RPT?
Absolutely. Auditors are always on the lookout for certain signs. Things like complex compensating balance arrangements, where maybe the company keeps a large deposit at a bank as collateral for a loan made to a related party, or loan guarantees provided by the company for the benefit of a related party. Unusual, large, non-recurring transactions happening right near the end of the reporting period. Those always get extra scrutiny. Transactions where the term seems significantly different from what you'd expect in the open market, maybe unusually high or low interest rates, or very generous payment terms, and non-monetary exchanges, like swapping assets such as land for equipment, especially between related entities, where establishing a truly objective fair value can be difficult. These can all be signals that the transaction might not be what it appears on the surface. Once a significant RPT is identified, what does the auditor do then? Just note it down. No, they need to dig deeper. The auditor will carefully inspect the underlying contracts or agreements related to the transaction. They evaluate the business rationale, or sometimes the lack thereof, behind the transaction. Does it make sense from the company's perspective, or does it seem primarily designed to benefit the related party? Could it indicate potential fraud? They check if the terms of the transaction are consistent with management's explanations. They verify that the transaction has been properly accounted for and disclosed according to the relevant accounting standards. And they also obtain audit evidence that the transaction was appropriately authorized and approved by the right people within the company management, the board, maybe even shareholders, depending on the significance.
Let's use that example you mentioned about Doug and ABC Company. Can you walk us through how an auditor would handle that specific scenario?
Of course. So the scenario is, Doug owns 60% of ABC Company, making him a principal owner and thus a related party. ABC Company then buys a building from Doug for $15 million. However, the building's actual fair market value is estimated to be much higher, say $40 million. This is clearly not an arm's-length transaction because Doug, effectively controlling ABC, is on both sides of the deal. He's essentially selling the building to himself at a potentially favorable price. The auditor's job here is twofold. First, they need to verify that the transaction is recorded correctly on ABC's books at the actual transaction price of $15 million, according to accounting rules for related party transactions. But critically, this transaction must also be clearly and transparently disclosed in the notes to ABC Company's financial statements. The disclosure should explain the nature of the relationship, Doug being the owner, the details of the transaction, buying the building, the dollar amount, $15 million, and potentially why the transaction occurred or that it wasn't necessarily at fair market value. This really raises that important question about transparency.
Anyone reading those financial statements needs to understand the context of this transaction, that it involved a related party and might not reflect typical market terms to make informed decisions. It's all about giving the full story, not just the potentially misleading $15 million number in isolation.
Okay, that makes sense. Now, what if auditors discover previously unidentified related parties or transactions during the course of the audit? That sounds like finding a hidden room in a house you thought you knew everything about, a potentially big problem.
It definitely requires immediate and decisive action from the audit team. If auditors stumble upon related party relationships or significant transactions that management hadn't previously identified or disclosed to them, they need to, first, promptly communicate that information to the rest of the audit team. Everyone needs to be aware. Then they'll request management to identify all transactions with these newly discovered related parties so the auditors can evaluate them. Crucially, they need to inquire why the company's own internal controls failed to identify or disclose these relationships and transactions in the first place. Was it an oversight or something else? They then have to perform additional substantive audit procedures specifically on these newly identified parties and transactions. And importantly, they need to reconsider the risk that other unidentified or undisclosed related parties or transactions might still exist. This discovery casts doubt. Finally, they evaluate the overall audit implications, especially if the non-disclosure appears intentional, as that could be indicative of fraud risk.
And for publicly traded companies, the issuers, is there any additional specific guidance from the regulators, like the PCAOB?
Yes, for audits of public companies, the PCAOB, that's the Public Company Accounting Oversight Board, provides some additional specific procedures related to RPTs. Auditors should check if any exceptions to the company's established policies and procedures were granted for significant RPTs. They should evaluate the financial capability of the related parties involved, especially concerning significant unpaid balances, loan commitments, or guarantees. Can the related party actually fulfill their end of the bargain? And they generally need to perform procedures on significant intercompany account balances to ensure they reconcile and are properly accounted for, often coordinating work across different audit teams if subsidiaries have different auditors or year ends.
All right, let's shift gears slightly. Our next area deals with future uncertainties, things that might happen but haven't yet. Litigation, claims, and assessments, often called LCAs. These sound like potential financial landmines for a company.
Exactly. Landmines is a good word for them. When auditors are dealing with actual or potential lawsuits, claims, or assessments against the company, their main goal is to gather solid evidence on three key things. First, when did the underlying cause for the potential legal action actually occur? Does it relate to the period being audited? Second, what's the probability of an unfavorable outcome for the company? Is it likely they'll lose the case or have to pay a settlement? And third, what's the estimated amount or range of the potential loss if the outcome is unfavorable?
How do auditors even find out about these potential landmines before they explode? Where do they look?
They use several methods to try and uncover these. It typically starts with inquiring directly with management about any known litigation or unrecorded claims. They review correspondence and invoices from the company's external attorney's legal bills, often mention specific cases. They might check IRS reports for details on any unsettled tax disagreements or proposed assessments. They review the minutes from board of directors meetings and shareholder meetings, as significant legal matters are usually discussed there. And critically, they obtain two key documents: a formal letter sent directly to the client's external attorney, and sometimes in-house counsel, and a management representation letter from the client.
So management is still the first line of defense here, right? They're supposed to tell the auditor everything about potential legal troubles.
Yes, absolutely. Management has the primary responsibility for identifying, evaluating, and accounting for all contingent liabilities, including these LCAs. The management representation letter is a key piece of evidence where management formally states, in writing, that they've disclosed all known actual or possible claims and assessments to the auditor.
You mentioned that formal letter to the attorney. That sounds like a really important tool, getting information straight from the legal experts. Can you explain that a bit more?
It is perhaps the most important single piece of evidence for auditing LCAs. This document is commonly called the Letter of Inquiry to Clients' Attorneys, or simply the Attorney Letter. While it's prepared by management, asking the attorney to corroborate information provided to the auditor, it's actually sent by the auditors directly to the entity's external legal counsel, and often to relevant in-house legal counsel too. This provides a direct, independent channel for the auditor to obtain or corroborate information about litigation, claims, and assessments directly from the company's legal experts.
What happens if a client refuses to let the auditor send this letter to their attorney? Does that immediately signal a big problem?
Oh, absolutely. That's a very significant red flag. A client's refusal to permit this direct inquiry of their attorneys is a major scope limitation. It usually results in the auditor issuing what's called a disclaimer of opinion, meaning they can't give an opinion on the financial statements at all, or, in some cases, even withdrawing from the audit engagement entirely. It strongly suggests the client might be trying to hide something significant.
Okay, assuming the client agrees and the attorney responds, do they just tell the auditor everything about every little legal disagreement the company is involved in?
Well, their replies go directly back to the independent auditor, not through the client, which maintains independence. Attorneys are asked to provide their professional evaluation of the matters listed in the letter, including the expected outcome of the case, if possible, and their estimate of the likely financial liability or range of loss. However, there are a couple of common limitations you often see in attorney responses. One is the substantial attention limitation. Lawyers will typically only comment substantively on matters they've personally devoted significant time and attention to. They won't speculate on things they only know about peripherally. The other is the confidentiality limitation. Sometimes disclosing certain sensitive information directly to the auditor could potentially harm the client's position in a negotiation or lawsuit, for example, revealing a specific settlement strategy or acknowledging a potential patent violation that hasn't been formally asserted yet. Attorneys are careful about waivers of privilege.
What if an attorney just outright refuses to respond on a significant matter that they have clearly given substantial attention to?
If an attorney refuses to furnish the information requested in the inquiry letter about a matter they've worked on significantly, that's also considered a scope limitation from the auditor's perspective. It means the auditor couldn't perform all the necessary procedures they deemed important. This kind of limitation is serious enough to prevent the auditor from issuing an unmodified or clean audit opinion.
And sometimes I imagine even the attorneys might not be able to predict the outcome clearly. There might just be too much uncertainty about a complex case. How does the auditor handle that level of unknown?
That definitely happens. Sometimes, due to the inherent uncertainties of litigation, even the attorneys can't form a clear conclusion about the probability of loss or estimate the amount. In such cases, if the auditor is satisfied that the financial statement disclosure about this uncertainty is adequate, meaning the company has clearly explained the situation and the potential risks in the footnotes, even if they can't book a specific liability, then no modification to the audit opinion itself would necessarily be required. The uncertainty is disclosed, which is key. It's important to remember that while management is the primary source for identifying and providing information about these potential liabilities, the attorney's letter serves to corroborate that information. It's a crucial cross-check. So what does this all mean for you listening? It's really all about the auditor trying to get solid, independent backup for those tricky, uncertain future unknowns that could significantly impact the company's finances.
Once all this information is gathered from management, from the attorneys, from meeting minutes, what are the concluding procedures for the auditor regarding LCAs?
After reviewing all the evidence, including receiving and analyzing that crucial attorney's letter, the auditors analyze all the information gathered. They need to ensure that management has properly accounted for any potential losses that are deemed both probable and reasonably estimable. That means actually recording a liability on the balance sheet. And, just as importantly, they verify that any potential losses that are considered probable but not estimable, or those that are reasonably possible but not probable, are adequately disclosed in the footnotes to the financial statements. It's about making sure the full picture of potential risks, including all the significant maybes, is clearly communicated to users of the financials.
Okay, that covers litigation risk. Finally, let's turn to what sounds like maybe the most fundamental question of all about a company's future. Going concern. What exactly is this assessment?
It absolutely is fundamental. The going concern assessment is a critical evaluation the auditor must make regarding whether the entity has the ability to continue operating for a reasonable period of time.
Mm.
It essentially questions the very basic assumption underlying most financial reporting, the assumption that the business will actually stay in business and be able to meet its obligations as they come due, rather than having to liquidate or cease operations. For you, the investor, the lender, the employee, this is perhaps one of the single most important assessments an auditor makes, as it speaks directly to the company's near-term viability and survival.
And what's generally considered a reasonable period of time for this assessment? Is it like the next 5 years, 10 years? Is it universally defined?
It's generally shorter term than that, and not quite universally defined, actually. For non-governmental entities following FASB rules, which is most U.S. companies, the reasonable period is generally considered to be 1 year after the date the financial statements are issued or are available to be issued. For state and local government entities following GSB rules, it's typically 1 year beyond the date of the financial statements themselves. Plus, they need to consider information that might raise doubt that becomes known shortly after that 1 year period, usually within about 3 months. So, slight differences, but generally focused on the next year or so.
Okay, so if conditions or events arise during the audit that make the auditor think, maybe this company won't make it through the next year, that casts substantial doubt on its ability to continue as a going concern. What specific steps does the auditor have to take then?
If that substantial doubt arises, the auditor needs to perform additional procedures. They need to obtain more evidence specifically related to those conditions or events. They have to look closely at any factors that might mitigate the doubt, things that could counteract the negative signs. They also must carefully evaluate management's plans to address the problems and alleviate the doubt. Are these plans feasible, likely to be effective? Then, based on all this, the auditor has to conclude whether substantial doubt still exists after considering mitigating factors in management's plans. They also need to conclude if using the going concern basis of accounting is still appropriate for preparing the financial statements. Meaning, is it still realistic to assume the company will continue, or should they perhaps be using a liquidation basis, which assumes they're winding down? And finally, they assess the impact all of this has on the auditor's report and the financial statement disclosures.
You know, when you lay it out like that, it really makes you appreciate the sheer amount of foresight and judgment an auditor needs. It's not just looking at the past numbers, but really projecting into the future, assessing viability. That's tough. So, what are the common warning signs? What kinds of conditions or events typically trigger this substantial doubt? I hear there's a handy mnemonic auditors sometimes use, FINE. Can you break that down for us?
That's a great point about foresight. It's absolutely crucial here. And yes, FINE is an excellent way to remember the common categories of red flags. F stands for financial difficulties. This includes things like the company defaulting on loans, having trouble paying dividends, being denied credit by suppliers or lenders, having to restructure debt under unfavorable terms, not meeting mandatory capital requirements, failing to secure needed new financing, or being forced to sell off substantial assets just to generate cash to survive.
Okay, F for financial. What's I?
I stands for internal matters. These are problems within the company itself, such as significant work stoppages or ongoing labor difficulties, heavy dependence on the success of just one particular project or product line, uneconomic long-term commitments that are draining resources, or the need for significant revisions to operations that aren't working out well.
N.
N stands for negative trends. This is about patterns in the financial data, like recurring operating losses year after year, persistent working capital shortages, not having enough current assets to cover current liabilities, negative cash flows from operations, meaning the core business is losing cash, or consistently poor key financial ratios compared to the industry.
And finally, E.
And E stands for external matters. These are factors outside the company's direct control, such as ongoing legal proceedings that could be crippling, the passage of new laws or regulations that significantly harm the business model, the loss of a key license or patent, the loss of a principal customer or supplier that they heavily relied on, or uninsured or underinsured natural disasters that severely impact operations. Any combination of these fine factors can raise that substantial doubt.
That's a really clear way to categorize those potential risks. Thanks. But what if management sees these problems and says, don't worry, we have solid plans to turn things around? Do auditors just take their word for it? How do they evaluate those plans?
Auditors definitely consider management's plans very carefully. These plans might involve things like borrowing more money or restructuring existing debt, selling off non-essential assets, delaying planned capital expenditures, cutting costs, or trying to raise new capital by issuing more stock. However, and this is absolutely key, these plans must demonstrate both the intent and the ability to be effectively implemented. It's not enough for management to just say they'll do something. The auditor needs evidence that the plan is feasible and that management actually can and will execute it successfully, and that it's likely to actually mitigate the going concern issue within that reasonable period. Even if the auditor concludes that management's plans do successfully alleviate the substantial doubt, adequate disclosure of the underlying conditions and events that caused the doubt in the first place, along with the main features of the plan, might still be necessary in the financial statement footnotes for transparency.
Okay, so let's talk reporting. How does this whole going concern assessment actually show up in the final auditor's report for, say, private companies or non-issuers?
All right, for non-issuers, if the going concern assumption is ultimately deemed appropriate, and management's plans have successfully alleviated the initial substantial doubt, and all the necessary disclosures about the situation are adequate in the footnotes, then the auditor may choose to include an optional paragraph in their report called an emphasis of matter paragraph.
Optional.
Yes, optional in that specific scenario where doubt is alleviated, but disclosure is important. This paragraph doesn't change the main audit opinion. It would still be unmodified or clean, but it specifically draws the reader's attention to the footnote discussing the going concern matter. It's like saying, everything looks okay now, but you should really read this note about the issues they faced and the plans they made. However, if substantial doubt remains even after considering management's plans, the situation is different. The auditor must include a mandatory separate section in the auditor's report. This section has a specific required heading: substantial doubt about the entity's ability to continue as a going concern.
That sounds like a major red flag.
It absolutely is. It's a very significant communication. This required paragraph explicitly states that substantial doubt exists, refers the reader to the relevant footnote disclosure detailing the conditions, management's plans, etc., and importantly, it clarifies that the auditor's main opinion on the financial statements themselves is not modified solely because of this uncertainty, assuming the disclosures are adequate. It's the auditor formally warning users about the potential risk to the company's survival.
Is the reporting different for publicly traded companies, the issuers reporting under PCAOB standards?
Yes, slightly different terminology and requirements. For issuers, when substantial doubt exists, whether it's alleviated or not if disclosure is needed, an explanatory paragraph is typically added after the opinion paragraph in the auditor's report. This explanatory paragraph must include the specific phrases substantial doubt and going concern. Highlighting the issue is mandatory if doubt exists. While adding this explanatory paragraph is the general rule for issuers when doubt remains, auditors also have the option, particularly in very dire or uncertain circumstances, to disclaim an opinion entirely, essentially saying, the uncertainty surrounding the company's ability to continue is so pervasive we cannot form an opinion on these financial statements.
Got it. And all of this complex assessment, the conditions found, management's plans, the auditor's conclusion needs to be thoroughly documented in the audit files, right?
Absolutely. Meticulous documentation is crucial. The audit work papers must clearly detail the specific conditions or events identified that initially caused the substantial doubt, any significant mitigating factors that were considered, all the audit work performed to evaluate management's plans, including copies of the plans and any written representations obtained from management about their intent and ability, the auditor's final conclusion on whether substantial doubt remains or was alleviated, and of course, how this conclusion affected the financial statements, for example, adequacy of disclosures, and the final audit report, example, inclusion of an emphasis of matter or going concern paragraph. It's all about creating a clear, auditable trail of the judgment process.
Are there any other critical considerations or potential outcomes related to going concern that we should touch on?
Yes, a few important ones. First, if the auditor believes the company's disclosures about its going concern issues are inadequate or misleading, that itself is considered a departure from the accounting framework, JAP. This would lead to a modified opinion, either qualified, except for the inadequate disclosure, or adverse. The financials are misleading due to the lack of disclosure. Second, if management is unwilling to perform or extend their own assessment of the company's ability to continue as a going concern when the auditor believes it's necessary, that could also be a scope limitation leading to a qualified or potentially a disclaimer of opinion. Third, if the auditor concludes that the very basis of using going concern accounting is inappropriate, meaning liquidation is imminent or virtually certain, that an adverse opinion should be expressed because the financial statements prepared on a going concern basis would be fundamentally misleading.
It's also worth noting that if substantial doubt existed and was reported on in the prior year, but the conditions have since been resolved in the current year, the prior period's going concern section or paragraph doesn't need to be repeated in the current year's comparative report. And finally, like other significant findings, any identified going concern issues must always be clearly communicated by the auditor to those charged with governance, the board or audit committee. They need to know. If we really connect this back to the bigger picture for everyone listening, the going concern assessment is truly paramount. It fundamentally questions the very bedrock assumption that a business will stay in business long enough to realize its assets and pay its liabilities in the normal course. It's not just some technical accounting requirement or a check-the-box exercise. It's about assessing the very future viability of the company. And by extension, it impacts the relevance and reliability of the financial statements themselves. If the company might not be around next year, how you interpret this year's numbers changes drastically.
Wow, what a journey we've taken today. Seriously, from making sure companies follow sometimes obscure regulations, to evaluating complex estimates based on judgment, to untangling related party deals, and finally, to assessing their very survival. It is crystal clear that an auditor's job is so much more than just crunching numbers in the back room. It's really about deep investigation, applying critical judgment, professional skepticism, and ensuring clear communication, all designed to give you, the listener, a truly reliable picture of what's going on inside a company.
Absolutely. I think this deep dive has really shown us how auditors navigate these incredibly complex, often very nuanced areas of engagement risk. It's a constant dance, isn't it, between performing very detailed, specific procedures based on standards and applying that overarching professional skepticism and judgment to situations that don't always fit neatly into boxes, all aimed at bridging that information gap between a company and its stakeholders, providing that crucial assurance to the financial markets and ultimately to you.
So, thinking ahead. As the business world inevitably becomes even more interconnected, more global, and certainly more technologically driven with things like AI and complex data analytics, what do you think might be the next frontier of audit risk? What new challenges might emerge that require a whole new set of considerations, potentially reshaping how we even view financial transparency and the role of the audit in the years to come? Something for us all to think about.